We're back with Grant White, portfolio manager and investment advisor at IA Private Wealth. Grant, we'll put up a one-year chart for the S&P and the TSX. TSX, of course, hitting a record high this week. You say that there's evidence that this is not a sucker rally, that it could be sustainable.
Yeah, I mean, I really think so. I think so because, I've had, again, calls coming in from other portfolio managers and saying, how are you enjoying the false rally? And I'm like, what false rally? I mean, we're seeing nice volumes come in on this. I mean, if it was a bull trap, we wouldn't be seeing the volumes buying in on the upside. And so I actually think that, yeah, we're going to see volatility continue to be going forward. And, I still think of these markets as very predatory, especially to the undisciplined investor. So you have to be careful with it. And especially as we see the impacts of tariffs, that we'll start to see through Q2 here and what that ultimately is meant and what that means going forward. But all this is to say is, like, I don't think that this is a typical bull trap that a lot of portfolio managers are maybe concerned about, because the volumes have been there and that's been driving things, in terms of momentum. Now, again, expect volatility. I think that's the story of this year is we're going to see continued volatility throughout the year. And I think that, certainly can be a trap for a lot of investors out there. But for the disciplined investor, I think you're going to get some really great opportunities. And you need to take advantage of that. I think this is going to be a great market for us, actually.
And don't obsess about the headlines. President Trump's latest pronouncements, for example.
Well, it's hard to ignore. I mean, there's a lot of noise out there. I mean, that's part of the danger in these markets is there's a lot of noise. These are louder markets than I've remembered in a long time, to be honest. Well, probably since 2016 to 2020. But in any case, they're very loud. They're very good at shaking investors out. I mean, hey, ignore the noise as best you can, but it's going to be hard to ignore. I think that this is where you want to make sure that you have a really good strategy, a really good philosophy behind your portfolio and you're sticking to it. And when those opportunities come in, buy up, and I think you're going to do very well by doing that. But just don't focus too much on the short term. I mean, the next 3 months, the next 6 months, that doesn't really matter when you're investing in the markets. You look ahead as to what's going to happen over the next few years, and I think you're going to get some great buying opportunities here. And I think we've already experienced that, and I think there'll be more.
Power Corporation of Canada, the financial conglomerate. Do you think this looks like a decent bet right now?
Yeah, I do. I mean, we were talking about banks before the break, and I think if you're looking for an alternative to a bank and you're looking for something kind of similar, I mean, this is one of probably the least exciting ideas in my portfolio right now, but that's great. It's a stable and boring company. But here's the thing with it: when you factor in the dividend yield and the share buybacks, you're getting like over 6% in terms of total yield just buying up this company. So you don't need a whole lot of a share appreciation on top of the buyback yield and the dividend yield and to generate a decent return off of this. I mean, even at inflation, we're looking at about 8% type of returns per year with a company like this. So I think Power Corp is extremely well positioned. We've seen really nice growth in a lot of their good core assets, whether it's Great-West Lifeco or IGM. They're doing very, very well in the wealth management space. I expect that they're going to continue to do well. And the thing with Power Corp is you get consistency. You know what you're getting with this company because the management has been so consistent for so long. So I think you can do very, very well with this very boring stock. It's just a company that continues to chug along.
Right. Life insurance, mutual funds. Yeah. Okay.
Yeah. All the fun stuff.
You have something a bit more exciting, arguably, here. Alphabet. People excited about their AI prowess.
Well, I've been excited about Alphabet for a long time, and we've owned Alphabet probably close to 10 years at this point. And what I'm particularly excited about with Alphabet now is some of those things that we liked 10 years ago are now coming online. So the AI story, of course, I mean, that's been more recent over the last couple of years, and with the recent releases coming over the last few days, I don't know how you're not excited about where they are in terms of AI. I mean, whether they're leading the way, they're very close to leading the way, if not completely taking over. So I think that Alphabet is very, very well positioned for the next stage of AI, especially as more agents come online. And if you haven't watched their videos, you should watch their videos because it's fascinating stuff. So I think they're going to do extremely well in this new AI industry that's coming out and what that means for the world. But you got to consider other things like Waymo, for example. I mean, if you took Waymo and you basically said that, hey, this is probably going to be like Uber, and if you took Uber's valuation, you had basically $200 billion onto Google or Alphabet's balance sheet. I think you're getting Waymo for free right now, and Waymo looks to be well ahead of any other robo-taxi service. You know, Tesla's making big announcements, but I think if you like that robo-taxi story, you have to like Alphabet because they're already there and they're producing and executing on it. Other companies that they own into is SpaceX. I mean, you know, they have about an 8% position in SpaceX, I believe, which today is worth about $35 billion. Again, they don't get any credit for this, but they are the second biggest shareholder of SpaceX, according to my last records, other than Elon Musk. And so you're getting a really great, you're getting a great conglomerate of assets here that most of it hasn't really been priced in. Now, there are some concerns about, you know, what does AI mean for search going forward? And I think that is something that, you know, you need to be looking at because they're facing a bit of an innovator's dilemma there. I mean, you know, search still generates about $200 billion a year in revenue for this company, right? Which, as we know, we're switching away from traditional search due to AI models. But you know, as they pointed out in their most recent releases, I think they've figured out a way to navigate through that by adding AI as part of the search toolbar going forward. I think they're going to navigate this well, and I think they're probably one of the best positions to do it. Now, just one last thing on Alphabet, because nobody thinks of Alphabet as a yield company, and I haven't thought of it like that. But you know, they have a small dividend. But again, I love share buybacks, and Alphabet is engaged in share buybacks. And when you add again those two pieces together, you're getting about a 4% yield between share buybacks and dividend yield at Alphabet, which for a company of this size is absolutely massive. So a fantastic business. I think they're going to do really well going forward. Hard to buy them cheap, but I think there's been some opportunities created more recently. So I think it's a great company.
Yeah, the yield only about 0.5%, but you say the share buybacks get that up to a much higher level. Always great hearing from you. Thank you very much, Grant.
Yeah, my pleasure, Andy. Thanks so much. Take care.
Grant White, portfolio manager and investment advisor at IA Private Wealth.